Welcome to the fourth lecture of Unit 2 in the Ethan Trades Mentorship. In this lecture, you will be learning the difference between strong and weak swing points in a market structure. This will be a short lecture just to get you familiar with the concept and so that you are able to identify when a market is shifting from bullish to bearish or bearish to bullish. A strong swing point is the swing high or low that takes out a prior high or low of a range with displacement. Displacement meaning price obviously trades through a level. As we move forward in this mentorship, there will be much easier ways to tell whether displacement has occurred or not, but for now, just understand that it is a clear price movement above or below a prior swing point. In this schematic, you can see we have a very simple trend, bullish on the left and bearish on the right. Each one of the solid curves representing a strong swing point and a dotted curve representing a weak swing point. So on the left is the bullish example. In the bullish example, each time a higher high is put in, we can expect the low that sent price there to be a strong low. This is often referred to as a protected low as well, because we expect this low not to be traded to for a while. As for the weak swing points in the bullish example, it would be the highs since it is consistently putting in higher highs and higher lows. So this low to this high would be the barometer that we're using here to start off this bullish trend. And so by looking at this low and high, this would be that first range we're looking at. So from this low to this high is a range where we can mark out this horizontal line to delineate the high of the range and delineate the low of the range. And so you can see how this high to this this low to this high creates a range, and so we trade back into it. We form a higher low, and once this higher low is responsible for taking out this previous high, once that happens, we create a higher high, and so we can use this higher low as a new reference, as a strong swing point. We expect this not to be retraced to or traded back into for a while, and so we can use this strong point or strong swing point as the new range low and this higher high as the new range high. And we're expecting this higher high to be a weak swing point because we are in a bullish trend, meaning we're looking for higher highs and higher lows, right? So if we're putting in higher highs, we're expecting prior highs to be taken out each time. So here, once we put in the higher high, we get another retracement lower, creating a higher low. And once this higher low takes out this previous high, once again, this becomes a strong swing point. And we can look at this low to this higher high as a range. And so here I put this eyeball here just to show expectation of what we're looking for next, right? Because we're in a bullish trend. We are looking for price to trade back into the range between this higher low and this higher high. Once we're inside this range, we're looking for this higher high to be a weak swing point, meaning we're expecting price to trade back up into that. And so vice versa, in a bearish example, each time a lower low is put in, we can expect the high that sent price there to be a strong high. Once again, this would be referred to as the protected high because we expect this high not to be traded to for a while. As for the weak swing points in the bearish example, it would be the lows since price is consistently putting in lower highs and lower lows. One thing to note here is that once again, between each price leg, we can use these as ranges. And in the next lecture, I will be explaining premium, fair value, and discount ranges, which will be using these specific price legs as our range. So just take note of this, how we're using each leg as a range, because this is going to be very important moving forward to determine when to buy, when to sell in the market. And once again, at this stage of the mentorship, you shouldn't be trying to trade the market yet. There's still a lot of fundamentals that we need to get through. Once it is time to start live trading, I will introduce all the different things you need, all the different tools you need to start trading. But for now, just learn the concepts and study price action first. And once you get that going, we can get into trading actual capital. In this slide, I've included a complex example where each pullback in price has multiple legs of price. So I include this schematic because the market will most likely never be picture perfect, and majority of the times you will have some sort of variation of the schematic. Remember, a strong swing point is only created when the range of a previous high and low has been taken out with displacement. And so if you look here, on the left is a bullish trend, right? And the right is a bearish trend. Once again, it's just going to be a more complex example because now in each pullback, you have multiple price legs. And so this low to this high is this, once again, the barometer to start off our trend here because we don't have any previous price action. So just this low to this high. You can look at this low, draw a line to delineate the low of the range, and this high to delineate the high of the range, right? Price trades down, creates this low, which is a higher low, creates a lower high. These are going to be weak swing points because none of these swing points create any price action of significance, right? So you can see here, this low fails to take out this previous high, and then this high fails to take out this previous low. So the range extremes are still intact. We're not really paying attention to these highs and lows as anything significant. And so once we have this higher low put in, the second one, and it takes out the prior high, we can look at this with significance, where this is now the new strong low because this took out the previous swing high of the extreme, right? The extreme high of the previous range. And so once that occurs, this higher low, we can draw out a horizontal line once again to delineate our extreme low of the range. And this higher high, we can draw a horizontal line to delineate the extreme high of the range. And just repeating the same pattern where we have this complex pullback because it's multiple legs inside. And we're just kind of looking at it like that. Vice versa. On the bearish example is exactly the same thing. This high to this low is just going to be the barometer of what starts the trend because we don't have any price action prior to this. And so this high to low, you can look at it as the high is the extreme high of the range. The low is the extreme low of the range. And we're just looking for price action that is responsible for taking out one side of this range. And so that's why this higher high, or sorry, this lower high right here that forms fails to take out this previous low, which is why it's a weak swing point. And then this higher low right here fails to take out this previous high of the extreme high of the previous range, right? So we look at this as a weak low. And once this lower high gets created and takes out this previous extreme low of the previous range, that becomes a strong swing point, and that becomes our new range, this lower high to this lower low. Next are market structure shifts. The acronym for this is MSS. You'll hear or see this term referred to a lot in market structure. A market structure shift just simply means that the market is changing direction and putting in the opposing bias's market structure. So if the market is moving bullishly, then a market structure shift indicates that the market is starting to move bearishly. Vice versa, if the market is moving bearishly, then a market structure shift indicates that the market is starting to move bullishly. For a market structure shift to occur, a strong swing point must be traded through. In this slide, the schematic depicts a bullish market structure shift example. And so here you can see on the left, I've included the simple example or the simple trend into a market structure shift. So you can see we have a bearish trend here, high, low, lower high, lower low, lower high, lower low, right? It's just simple bear trend. And once we take out this strong swing point, right, this lower high that takes out the previous low, so we can look at this lower high as a range high, this lower low as the range low. Once we invalidate that or trade through it with conviction, we can look at this as a market structure shift, and we're expecting this higher high to become the new weak swing point because we're looking for a bullish trend now instead, since we have a market structure shift. On the right side here is a little more complex example, but the concept stays the exact same, right? So here, this high to low is going to be the barometer to start off our trend. Once this lower high takes out this lower low, sorry, not this lower low, just this previous low of the range low extreme, we look at that as a strong swing point. And so this lower high right here causes nothing of significance because it fails to take out the extreme low of the previous range, or the current range at this time that this is created. And then this higher low right here, I actually messed up here. This should be a strong swing point right here because this higher low takes out the previous range high. So this extreme high, this low right here, this higher low is responsible for it. So that's where I made a little mistake. So you guys are going to have to kind of adjust on that, where this higher low is the strong swing point and this lower low is the weak swing point, or you can also look at it as strong swing point. Either one works. And vice versa, this is schematic of a bearish market structure shift, right? Once again, on the left side, we have a simple example where it's a bullish trend, right? Where low, high, higher low, higher high, higher low, higher high. This is a bullish trend, very simple. And once we take out this strong low right here, this higher low, we can have that market structure shift, right? And then on the right side here, once again, that complex example, where we have the bullish trend and then this higher low fails to take out the previous high, which is why it's a weak swing point. We expect it to be traded into. This lower high is also, you can view it as a strong swing point, just like the previous example where I kind of messed up a little bit here with the annotation. You can look at this one as a strong high as well, because this one takes out this higher low that is the strong low originally, and so that causes the market structure shift. Once again, expectation wise, we would be looking at this lower low here. I annotated this wrong as well. It's supposed to be LL for lower low. I just kind of messed up on that annotation, but bear with me here. Apologize for that. But we would be expecting this low next, because this is the new weak swing point, because we have that bearish market structure shift for a bearish trend. Now that you understand how each of these components of market structure work together, you can put it all together just like how we did with the interbank price delivery algorithm lecture. And so, just like that IPDA lecture, I pretty much just copy pasted 3 different segments all together, and so you'll end up getting this, and this is what the market will generally look like overall in terms of market structure. So once again, a low to high, this can be your barometer, just like how we were talking about the complex pullbacks, right? So we're looking at the range high extreme and the range low extreme, looking at which low here within the range is responsible for taking out the previous high. And so we can see that this higher low right here takes out that previous high. This higher low is now the new range low extreme. This higher high is the new range high extreme. Once again, rinse and repeat. This higher low takes out the previous high, which creates a strong swing point once again. And we just continue that. And you can see here how we have this strong low, right? And we get a market structure shift here because a strong low is invalidated. So from this higher high, it takes out this strong low down to this lower low, which makes this higher high now a strong swing point because it takes out the prior range low extreme. So this higher low to this higher high would be the range, higher low being the range low extreme, the higher high being the range high extreme. Once that range low extreme is taken by this higher high, then we can look at this higher high as the new swing, the strong swing point. And so now we can see that how this market structure shift turns price from a bullish trend into a bearish trend. So that's why it's called a market structure shift, because it's just shifting the market in the opposite direction. So hopping into the live charts here, and I would have done this in the presentations that I normally do, but I really couldn't find a very practical way of doing it and sharing my thought process as I went along in the chart. So I'm just going to do this live so that I can show you guys how I would be looking at this piece of price action as if I were studying it myself. So I've put 2 vertical lines on the left and the right to delineate the example start and the example end. And so we can instantly take a look at this high and this low and just assume that's our starting barometer. So that's going to be the high and low. That's the barometer to start our bullish trend here, right? So we can look. This high right here originally is going to be the range high. This low right here is going to originally be the range low, right? Once this high is taken, you can look at this as a market structure shift because we have some bearish price action back here. We get this market structure shift, and so we can already automatically assume that we are in a bullish trend. We're looking for bullish price action, right? And so now we're looking, what is the higher high that is put in from this low? Well, we can see here that this is the higher high that is put in, this specific swing point up here, right? I just annotate that, right? This high and this low. This low is responsible for sending price all the way up here. And so now once we're inside this range, we see price trade back into the range, and now we're waiting for the next low that sends price above this high, creating that new range. And so we can look here, we can see that this low right here ends up sending price above this high, causing something called a break of structure. So a break of structure is just basically a terminology to indicate that a previous range high or low has been taken, but it's a continuation. So if we're expecting bullish price action, once that range high extreme is taken, we call this a break of structure. It's just a continuation in price, basically. The more important term to know is market structure shift, because that's when the market is changing direction. And so that's why I didn't really teach break of structure. Break of structure is pretty much just a continuation in price. And so now once this occurs, we can now understand that this range is now done with, right? We don't need this range anymore. We're now focusing on this piece of price action where we traded above this previous range high, right? And then we're looking for, where's the higher high that was put in? It was this high right here, right? And so now we can look at this range, this low as the new range low. This is going to be your strong low because this low is responsible for sending price up here, right? So now that you have the strong low, this is going to be the extreme low of the new range. This higher high that just got put in is going to be the extreme high of the new range. And you're expecting this high to be taken out because you're expecting bullish price action. And this would be your weak swing high. And so once that's created, you just rinse and repeat, right? We take out this high. And so now we can pay attention once again. What is the low that sent price action above this high? Well, you can see that this low right here sends price above this high with conviction, right? You can see the bodies of the candles. It clearly trades above it, right? And so now, once again, you can kind of delete that old range and you're paying attention to the new range. So which low sent price above this high, this previous high range? It would be this low. And where is the new higher high being created? And so you can look at it as this high. But once again, you want to look at candle bodies. So automatically what my eyes kind of draw to, just because it is a hindsight piece of price action, my eye automatically draws to this high. But we can continue looking at every individual high, even as it's live printing. So this would have been the new higher high right here. And so right here, you would have the range high and the range low once again. And so you just rinse and repeat the same thought process here. Once this occurs, what is the low that sends price above this range high? It's going to be this low right here, right? So once this low sends price above there, you can understand that this is going to be your new strong swing low. And so you're drawing out, this is going to be your range low. And then this is going to be your new range high because this is the higher high that got put in. And so now you can kind of see how this thought process works, right? And so once again, rinse and repeat. What is the low that sent price above this range high? It would be this low right here, right? This low sends price above. Once again, pay attention to candle bodies. If you pay attention to candle bodies, it clearly trades above this previous range high. And so from that, now we can delete the previous range, expect this new low to be our strong low, right? And where's the higher high being put in? It's this high right here. And so once we have this high, this is our new high right here that we're expecting to be taken out, right? Because we're in a bullish trend. But what happens here instead of this high being taken out is that this strong low gets taken out instead by price right here, right? And so once that occurs, once the strong low is invalidated, we can look at this as a bearish market structure shift, right? And I'm just going to add some annotations here to make it a little clearer for you guys, right? So we can look at this as the bearish market structure shift. And so we're just continuing exactly what we did on the bullish side of, well, we call it a curve, and we'll explain why it's called a curve later, but the bullish trend, right? We were expecting higher prices. Now we have a bearish market structure shift. We're going to be expecting lower prices, right? And so now this low right here is the new lower low that was just put in by this higher high. And this higher high from this low is now the new strong swing point. We're not expecting price not to reach here, but expecting price to reach for this low instead because we had a bearish market structure shift. And so here I'm going to delete this dot and leave the bearish market structure shift annotation here. Leave the I'll delete the dot and leave the bearish market structure annotation here. And now once again, we would be anticipating that this low is the weak low, being the extreme low of this new range being created now. So this high to this low is now the new range. Once price trades through this low, we're looking at this high. Once again, that gets put in, right? We're looking at this high as a strong high expected. And then we're looking for the low here. Once again, I want you to pay attention to candle bodies. I understand you have a high and a low within one candle here, but pay attention to candle bodies. What is it telling you? It continues lower. And so my eye automatically draws to this extreme low here, which is going to be the new expected lower low of this bearish trend. So you can delete this previous one. And so now you have the range high of this previous leg right here. So the range high is this strong high, and the range low is this weak low right here, right? Once again. And so we can look at this as the new range. Once this once this lower high is put in, then we're paying attention. Does it take out the previous low, the previous swing low, which it does? So once again, rinse and repeat. This is going to be our new strong swing high. This previous weak low has been taken out. And so we're looking for continuation lower, right? And once again, you have a lower low here, which would become the new targeted weak low. This strong high is still going to be your range high. To this lower low is going to be your range low. And then once again, rinse and repeat. This new high that gets created, we're looking as the new lower high. And that's going to be our new strong swing point, which is going to be our extreme high of the new range. Once that gets taken out, we can look at these lows down here if you want. This low right here. My eye automatically draws to this low over here just because it pretty much plummets all the way down. But if you're looking at every single high and low, then this would be the low you're looking at. And so this would be the range low right here, gets taken out here. A new high is also created right here. So this would be the new lower high, being your new strong swing point and continuation. So I hope you get the point from that. And you can do this literally on any price action. I just chose something pretty clean for you guys to give an example to you guys. And if you struggle to see this pattern with candlesticks, a great trick that I love to do when I first started out is by using the path tool. I'll just click on all the points that is most obvious swing points to me. And so what looks like the most obvious swing points to me? Right. And so from here, I would just drag it underneath price. And then you can do your annotations on the line chart itself. And then highlight all your annotations, drag it over price, and then it'll line up, and then it makes things a lot clearer. So I hope this was insightful. And once again, very important to understand these ranges of price, right? What is strong low, strong high? What trend are we in right now? It's very important to understand these things for direction. That's all for this lecture, and once again, this is a very important lecture for you to understand because it will be one of the core fundamentals to your understanding of the markets. As always, the homework and quiz for this lecture will be posted in the description below. Don't cheat yourself of this learning opportunity. Study and do the work honestly. I promise your hard work will be rewarded. Your assignment for this lecture is to go into your charts and practice looking for the components taught in this lecture. I highly recommend doing annotations on this in your own charts until you can see it on a naked chart, meaning you don't need any annotations to see it. See you in the next one, and as always, have a great day.